All right, guys, we're gonna get started in like 1 minute here, but I just switched the screen over. Can you guys let me know if you can see it? You should be able to use the chat function. So the webinar chat function down there at the bottom, you should be able to chat to me and let me know you can see the screen. That'd be fantastic. So we got a few last minute scragglers, just jumped up about 20 more people. So, um, I know it's a tough choice between me and 60 Minutes, but I help people make more money than 60 Minutes, that's for sure. At least I'm not fighting with Jeopardy. If you're fighting with Jeopardy, I mean, that's a losing battle. Eddie, thank you. Brian, thank you. Nina, thank you. Rob, awesome. Perfect. Thank you so much. Good to see you, Rob, too. I hope your vacation and all that went well. Last time we talked, I think you were headed on vacation. Let me see here. Perfect. Eddie, Bob, Bill. Thank you, Andrea. All right, well, it's 7 o'clock, guys. We got about, a couple minutes before we begin here, or we're gonna jump right into it because, we got a lot to talk about. Don't know if you heard, but there was like a couple of things that kind of happened this past week that made the markets move a little bit. I don't know if you guys heard about this or not, but maybe you didn't. So hopefully this isn't hopefully this isn't all news to you, to say the least. But we're gonna break down and do what we do every week. We're gonna talk some economics, we're gonna talk some news, we're gonna talk what to do, we're gonna talk what to expect, we're gonna talk some trading setups, and I'm gonna get some things and opinions from you. You guys can use this chat box as much as you want. But before we jump in, I always have to disclaim the disclaimer, if you will. Got to let you know, not a commodity trading advisor, simply here to show you opportunity. What you do with that opportunity is all up to you, as well as you got to be aware of any and all trading risks, understand that risk, be willing to accept that risk and take on that risk. Any trades I show here today, if you decide to take them, that is of and on your own volition. Now, if I bang my face into this microphone one more time, we're gonna get into a fight. I'm gonna get into a fight live in a webinar. But For those of you guys that don't know me, my name is James Bishop. Um, I have been in trading education for 15 plus years. I've been an analyst. I've worked one-on-one with students. I see some of them in here today. Dr. T, I see you here. I see who else? I see quite a few individuals here that I've worked with. I've been around. John O, good to see you here as well. Glad you could make it, John. And Todd, my man, so glad to see you, brother. I've been an analyst. I worked one-on-one with students. I created courses. I did so much for so many different people, but during my tenure doing that. And then I became a analyst and a senior market analyst where I created courses, hosted trading sessions. I've created my own systems and my own strategies. Went and got my degree in finance and global portfolio management, where I became more classically trained in understanding the fundamentals of the market. Whereas in trading education, I learned technicals. I'm working on my doctorate right now in finance and economics, which is leaves me absolutely no damn time, to be honest, because I also own a managed fund, which I'm proud to say we're up like, I think, 12 or 13% this year so far, which is doing quite well. Even in this down market, we made money because we know how to maximize that, as well as I do retirement and estate planning, helping people not take part in losses. And we're going to talk a little bit about that here today as well. So, really quickly, just a quick housekeeping item, or well, a couple of things really quick. Purpose of this, right? Give you guys market insights, showcase some tools, talk economics, learn from you all, right? You got questions, and things like that that may come up. I want to learn from you guys, as well. I actually need to log into one of my systems here that I love to use. Um, and give me 1 second. And then lastly is okay. Now, offer insights into trading opportunities. Now the housekeeping items, okay? Couple of things that I want to announce this month. April 20th is Easter Sunday. Even I don't think that it is appropriate to host a session on Easter. So we're going to move that to Monday morning at 9 a.m. So we're going to do like a market open session. Okay. Uh, this is, oh, no, no, no. So, I have your name as new contact. It says, so what are you doing today? Tyson has invest for it, and this is trades trending. No, this is not trades trending. This is my own session. This is a give back session to you all to prep you for the week. We are not selling a damn thing here. You're not going to be asked to buy any damn thing. All I'm using are some tools that I use in my every single day. I offer analysis, I offer insights, and I go through the economics. Okay. You got an invite. That's how. So I will use Tyson's stuff. Tyson and I worked together for 10 or 12 years. So we pretty much analyze the markets very, very similarly, to say the least. But the other is on April 27th. All right. On April 27th, um, we are going to have a roundtable. We'll have Tyson Clayton, Hubert Centers, Silas, and Silas Peters, and myself and Mark will all be in the room together. That one will probably start a little bit earlier, last a little bit longer, because we're going to be talking about insights into the market and how to trade them, all of that. All right. So, again, I don't know your name. I wish you could tell me your name really quickly so I could adjust. Hold on. What is your name? How about that? But he has a master fib strategy. Yes, he does. I've been trading Fibonacci's for 18 years. I've been teaching them for that. So, okay. I got you, Jerry. Perfect. So, yes, you know me. All right, perfect. So, let's get into it. Okay. First thing I'm going to do is jump into a little bit of what's going on and what's happened, and then we'll talk what's to come as well. So I always like starting here. This is a program that no one in here needs to buy. It's called FactSet. It's basically a Bloomberg terminal. My university pays like 5 to 10 grand a month for me to have this because I manage an endowment fund for them. So, but it gives me a really, really amazing ability to curate at a like that what's going on in the world, as well as do deep dives into stocks that other tools don't have, and it gives me pricing a little bit quicker and news a little bit quicker than other places. So let's go through some things. Obviously the tariffs are really, really big right now. Another news article just came out. I think it was like 50 countries um, willing to negotiate on tariffs. I remember that, maybe that's a line from it or something like that. Let's see. Yeah, here you go. AP News, Reuters, whatever you want to go with, right? 50 nations, Vietnam and Taiwan say, oh, we're willing to give you guys 0% tariffs and things like that. Sure, but what does that represent as a whole as a trade? Okay. What does that represent as a whole for trade? That's a pretty big, very, 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 very small drop in the bucket, right? We're taking an eyedropper to the ocean. If Vietnam and Taiwan give us a free trade agreement, that's just is what it is, right? The goal of this, let's talk realism, and we'll talk what has happened in the past, and we'll talk a little bit about what's happening now. So the goal of these tariffs were to get countries, quote unquote, either A, create a better trade agreement for the US. Okay. So, um, it can go it can go a few ways, right? Let's see. How's my audio, by the way, guys? Is the audio good? Is it staticky? Someone said it's staticky. I don't know if it is or not. Audio good? Give me a wire yes if the audio's good. Todd says good. Fine, fine, fine. Perfect. Okay, good. So it may just be you, Jerry, on that end. Um, everybody says it's perfect. Good. Thank you. So the goal of the tariffs were right to create an environment where either A, other countries came to the table and helped negotiate and started negotiations and to lower their tariffs. B, create a trade balance between the two countries. Um, or C, create an environment where companies want to onshore manufacturing. Okay. Um, all right. Or C, you know, that to onshore manufacturing. And the reality is could that happen? Right? Yeah, potentially. But we've done this before. Right? We did it in 1927. You can look up what is it? Smoot-Hawley Act of 1927. They tariffed the basically created a universal tariff and tariff 20,000 different specific goods to try to onshore manufacturing. They were also at the same time were trying to get rid of lower immigration so the country could return to its glory days of the 1917s, et cetera, et cetera, et cetera. Well, that didn't work then because what happened from that fallout is it's locked up trade. Other countries use the tariffs that they impose on us and the extra money that comes from that to buy our debt, and that's what further finances the country. Okay, that's just a simple fact. I don't care who you argue, or we can't argue about simple facts. That's just what has gone on forever. Okay, and so yes, um, are tariffs a bad thing? Well, I'll tell you this: if the entire globe was at a 0% tariff with the US, then we would still have a trade deficit. Because in the US, we don't have enough raw material to put in factories, right? We can't mine copper here, we can't mine diamonds here, we can't mine, very little gold is mined here. We have, some oil, natural gas by the boatloads. We have some timber, corn, wheat, soy, and cotton. Those are our exports, right? Just like out of Chile, copper is the number one export, right? And out of Africa, they have a country rich in gemstones as well as metals. In China, they have graphene, they have lithium, they have iron, they have all sorts of things, right? So you have to look at what the country can in order to have sustainable manufacturing, right? You have to look at what the country's raw inputs can be for those manufacturing plants. The other thing is let's talk manufacturing. It takes roughly on the short end, 3 years to build a manufacturing plant. On the long end, about 8 years. So let's just keep it five, right? Let's just call it five. 5 years to build a manufacturing plant. That's just to build it and put the equipment into it. Now you got to train the people and you got to hire all the people. So that's another 3 to 5 years to get them educated, hiring. And then you got to get the manufacturing plant up to speed, producing at its optimal, speed of production. So that'll take about 8 to 10 years to do so, right? That'll take about 8 to 10 years to do so. So even if we began onshoring manufacturing today, it take 8 to 10 years to bring that up, right? It took 6 years for Taiwan Semiconductor to build their plant in Arizona, and they're bringing in staff now, right? I know what manufacturing jobs mean to parts of this part of our country. I'm not going to stick my head in the sand and say that it's not that good to bring it in, but we have to also think in reality, like what does this mean for long term? Is there a better way? Have a long vision but short steps, right? So, let's see. Um, Greater than, much less cost than in the USA. I'm not sure for it. No, not because the US health system is too expensive to employ US residents. I didn't say anything about the health system. The whole export of manufacture to the US to China and other countries was to take advantage of labor, much less costly than in the USA. Absolutely. 100% agree with you on that. Absolutely. Right. I'm talking about what these tariffs were supposed to do. You know what I mean? So, and the next thing, right, that is so that kind of refutes that fact about like, hey, could be a great thing. The next thing that could be an outcome of this, right, is well, if China exports more and they can produce pretty much anything the US can produce, or Russia or India, or would we just be pushing our current trading partners to go somewhere else? Right? Like, I live in Florida. Our grocery store is called Publix, right? Okay. So just don't shoot me here if yours is Kroger or Winn-Dixie or Food Line or whatever, right? But if Publix doesn't have something, I can go to Walmart, I can go to Target, I can go to another grocery store, I can go to specialty stores, right? I can go wherever. Or, if I don't like a certain restaurant, I can go to another restaurant that serves the same food. You know what I mean? And that's the similar situation that could occur, right? I'm not saying that it is. Not even saying that yet. The third thing that could happen is companies could begin to refute onshoring their products to the U.S. Okay, so um, right. So let's Brian, I'll address that in a second, but let's give so like Land Rover, for instance, and Land Rover Jaguar, and another car manufacturer, they're just going to stop sending cars to the US. They're just going to stop. So you won't be able to buy those here. So what happens to all those jobs? What happens to all the dealerships, the maintenance individuals, there's a trickle down effect of that, right? That's where trickle down does happen. Is now, okay, well, if we're not importing any cars, well, as the companies sell out of inventory, get rid of the dealerships, fire the salespeople, fire the managers, fire the finance people, fire the maintenance people, fire the people that are cleaning the buildings in the evening, right? That all creates and creates a tightening in there if countries decide to do that. Now, let's see. Brian Lee said, "Hey, it seems there's plenty of raw materials in the U.S. now. At the time of World War II, the U.S. was tops in manufacturing. That's ultimately what won the war. Don't see why it couldn't be ramped up again." Brian, the thing that really won the war, let's be real and let's be honest here, okay? And not to argue because this is not arguable. We dropped a nuke, we dropped a second nuke, and he said, if you don't, we didn't have the third one. And we said, if you don't sign this agreement, we're going to drop a third one. But we didn't have the third one. We could build it, but we didn't have it at the time. If you really go and you look at inventory, right? We import copper, aluminum. We have steel, yes. But remember, they took the copper that we were importing to make bullets for the war, right? That's what won the war. Canada was a big manufacturer of planes. UK manufactured the engines that went in the planes. So that's what, yeah, it did, Brian. Absolutely, it did. Um, you got, we got to go through history with you, bro, buddy. But I digress, right? What won there's so many things that oh, no worries, Brian, I don't take offense to that. There's so many other things. It wasn't just the manufacturing, right? And yes, manufacturing for countries is a great thing, but there's also three phases of an economy. There's an agricultural economy that will shift to a manufacturing economy. The manufacturing economy shifts to a production economy. That's what we're seeing in China, and why so many manufacturers are leaving China to go to Chile, to go to Argentina, to go to India, to go to Bangladesh, to go all over the world, because labor cost is cheaper other places than China, right? That's what the main thing is, right? Oh, Keith, I 100% agree with you, right? I think that there can be some manufacturing brought to the US. I think we should manufacture a lot of things. But can we compete on a level with China? No. And anybody who thinks that we can compete like that, anybody that does, go look at the market from 1927 to 1934. There was this little thing called the Great Depression. Herbert Hoover, who ran, this was his platform: deport immigrants, um, uh, onshore manufacturing, and raise tariffs. Telling you that's what happened, right? So we've seen this play out before. Now we can there could be things that change now. Absolutely, it could be different, right? Absolutely, it could be different. I am not saying that's what is going to happen, and I don't care about anybody's politics in here. Okay, um, I am going to say that I do not care about your politics at all, right? But there are so many factors that led up to that that we are seeing repeated right now. For instance, the largest wealth gap in US history. The largest wealth gap in US history. We represent 28% of global consumption with 12% of the population. So think about it this, if they don't ship to us, that means they're losing out on 12% of the buyers. They could just reduce how much they manufacture and sell everywhere else. That's one of the crazy things, right? So we're in a situation where we need to be proactive rather than reactive. And I don't say this all to drum up fear, to argue with anybody or anything like that. I say it all to tell you that there's going to be immense volatility over the next few months, and we have to be prepared to take advantage of that. The largest consumers. We are we're 20 we represent 28% of global consumption in the US, right? So for those that didn't know, with 12% of the global population. And 20% of our population is over the age of of 60 now. 20% of the US population. We're the third oldest population in the US, or in the globe, sorry. So that's another thing. Okay. Consumption, just consumption. Two-thirds of our consumption is just it in of itself, right? It's not like cans of spam. It's not like, it's not like consumption of ramen noodles. It's not consumption of eggs. It's just consumption. All right. So, oh, David, totally agree with you. Tax structure, wages, all of that. I agree with you there. Okay. Now, let's talk a little bit more about the effects of this, right? People would love to debate people in politics and policy and what caused what and this, that, and the third all day long. I can tell you we could talk about it all day long, but then that would leave us with no money making opportunities. So let's go into the money making opportunities, okay? This week coming up, New Zealand has their rate statement coming out, right? They're looking to cut rates again by another 0.25%. Governor Ueda is going to speak in Japan, so expect some movement out of the yen. Then we have inflationary numbers come out of the US as well. Okay. We have inflationary numbers come out of US. We have producer numbers coming out of the US, and then we have consumer sentiment coming out of the US. So this is what's forecasted for inflationary numbers. Okay. Core CPI month over month. We are looking at inflation core CPI raising a little bit, right? Previously it was at 0.2%. We're looking at it going up to 0.3%. Regular CPI, we're looking at falling a little bit, right? Mainly because food prices have stabilized, right? Prices have stabilized. So I was just honestly reading about that. Is that for the first time in since 2022, food prices have leveled off. Like there was no increase in food prices. So inflation was coming from sources other than food and energy. Year over year inflation, they're expecting to fall by 0.2%. Now, here's the thing you have to remember. April's numbers were based on March's movement. So, and we won't know the effect of any tariffs or anything like that until next month. Okay. So prepare for that. Consumer sentiment, though, they're expecting a 3-point drop in that, and we don't have inflation expectations yet. All right. So jumping into the charts and looking at what we see here, we see the Dow Jones, the S&P, and the NASDAQ here. Okay. And then I have the futures charts there. And we'll go over several different things, but in this chart alone, on the S&P 500, I know back in February when we started these sessions, right? I said, hey, look, be aware that we're going to be going after certain gaps. And we have fallen 17.47% since February 19th. Negative 17.47% since 19th. Okay. And what are we looking for here? So the first thing is that we have a downward fib move, right? So we have our ABCD here. We have, oops, did that, do that. There we go. Um, and I will give me a second after I do this. I'm gonna have everybody take a screenshot of this. You can do it with your phone. I don't care. Just figure it out. But this is our current fib we just filled. Um, and here is our kind of next fib. If we were to look at that, if this, I think we will pull back and fill these gaps here, right? So we have a gap right there and a gap right there. I think this week, you know, with some of the news that's coming out with the negotiations and stuff like that, great, right? We should see this push back up, right? We should see this push back up. Ford, great question, says, hey, non-farm payroll didn't last Friday did nothing to the stock market. Why? Because of the announcements on Thursday of the tariffs. Additionally, people already understand that non-farm payroll is going to grow uh, a lot because of government, getting smaller. Not again, think it's totally warranted personally, but it's gotten a lot smaller very, very quick. And so we're going to see, non-farm payrolls eke up a little bit as well. So that's why it's staying on. So we have, a potential for a pullback coming as well. Now, I'm going to add on a couple of indicators that I use all the time, and then we're going to check a couple other things as well. So, market energy and hedge fund trender are two things that I love to use. I'm going to get rid of some dots here in a second, just because I don't like looking at them. That's just it's personal. Um, but hey, it just is what it is. So you can be mad if you want to be mad, as my as my wife always says. Let me do this. Nope, I need that. We need to get rid of this one. These extra dots and those extra dots. Okay. All right, perfect. So what this is telling me is it's telling me that there is more, there has been a peak or a spike in amount of sellers. So the goal here is to get green over red will be buying and red over green is selling. So I anticipate we've broken through this. I anticipate there being some sort of drastic pullback, and we'll see that on smaller time frames happen first. Okay. So let's go to the ES and take a look at futures real quick. So if we go to the futures market, which it is moving because it's open, you can see there was, we continued on the selling and it's pulling back now. If we go to a 5-minute chart here, we just got on hedge fund trender, we just got a blue dot to begin to buy up. Now, something else I use all the time is this tool called Trend Insider. Okay. And I use it to kind of help me identify where the market is potentially going to. So I'm going to get in Trend Insider here in a second. I'm going to slide that over so it's not okay. Perfect. There it goes. We'll flip over to charts. And then I already have it on the S&P. Okay. So what this is showing me is it's showing me the last 10 years, this current year, the last 20 years, and since 93, right? Pretty much since, late March going into April, we should be looking for buying opportunity. But take a look at this. This is one thing I find interesting. Do you guys see this dip and those dips right there? Do you all see that? Oh, and I moved the arrows. My bad. Right here and here. Do y'all see that? Yes or no? Yep. Okay. Perfect. Okay, good. Thank you, Brian. Chris, yes, theoretically, if we continued the same amount of purchasing with the increase in prices. Okay. So, what you guys are seeing right now is this is how the market has moved every single day on average from 93 to 2025 for the last 20 years, 2005 to 2025, and 2015 to 2025, because the markets repeat themselves, right? So if you look here, we had the dip correlate on the same day. Now we may see a pullback here, and that kind of supports it, And then if we do continue on down the path and maybe we see that recession, we can also say, hey, what did 2008 to 2009 look like? And we can apply that and remove some of these other ones, right? I'll remove this year, remove that year, remove there. And I can see that back here on March, there's April, right? We had that dip in April, just like we had now. And then we had a rally up and we could see that, right? So that's a great, if you want to look at 87 and 89, at 87 and 89, you absolutely can. Right? Actually, no, you can't because there doesn't go back that far. Sorry, Ford. We could look at 99 to 2001, right? When you had the dot-com bubble. Okay. So, typical technical indicators and typical market. David, that's a really good question. So, I always say that fundamental news sets a direction, but technicals give it a destination, right? They're reasons, they're just psychological levels that people get to. And there are pauses at, right? And there's rebalancing that takes place after every big major market move. So if I know that from 93 to 2025, the market makes a low, for 20 years, the market makes a low. In 10 years, the market makes a low. In the dot-com bubble, the market made a low, all on the same day. And then we pulled back. Then I should expect there to be some sort of pullback. Does that make sense? Give me a wire yes. So after this, right, I'm not trying to get into a bias here. Let me tell you guys what I'm not going to do. Even though I see that the green is above and I got a blue dot, I'm not just buying to buy. I may buy a little bit and then I may buy another little bit, but I'm not going to just buy to buy. That's idiotic, right? I can't ignore the outside news, or the overall trend. So what I'm going to do is I'll buy a little bit of the pullbacks, but I'll also sell, right? And for those that don't know, the ES is the S&P 500, the futures contract on it. Costs you $500 to trade, and you make what, $12.50 a pip, basically, if you will. So it's an amazing, amazing thing here to look at the ES. Now, if we go and we look at the NASDAQ, right? So we were down, I'll write this down here. 17.4 in the S&P. Let's go over to the Dow. Right? The Dow again. Big fall since, February. Actually, really, the Dow started falling in January. We're looking at 14.97. And again, we're left with market gaps. We saw it out and filled some market gaps. And now we're looking, more than likely, we're going to see a little bit of a pullback, whether we go to 40,000 or back up to 41,000. I know they'll be rebalancing and rebuying by the major hedge funds and the big banks. That's just going to happen. So prepare yourself mentally to see somewhat probably of a little bit of a pullback, but we'll still push down, right? I don't anticipate this to not push down. And there's something else that we're going to get into if we have time here, called multiples. You hear about them on the news all the damn time, but most people don't know what the hell they really are. And we're going to talk about them. The NASDAQ. Now, a lot of people think that the NASDAQ, because there's, 1,000 stocks in it, it's a better representation of the market than not. Well, it's
very much overweighted tech. So no, the S&P is probably the best that you can look at for the broad market. Now the Nasdaq, the next gap in the Nasdaq is down here at 15,545, and we could see that 2,000 point fall. But we know that again, we know that the market is not just going to fall directly, or is not just going to move there in a direct line, right? Even though my favorite adage when it comes to trading is bulls climb stairs, right? So you can see this, right? Climbing stairs, climbing stairs, climbing stairs, climbing stairs, climbing up, and bears fall out of windows, right? Climb stairs, climb the stairs, climb the stairs, and oh crap, look what just happened. Same goes here, right? Bulls climb the stairs and bears fall out the damn window. That's just how the market works, right? So it's easier to create a panic in the market than it is to create a buying behavior after the panic, you know? So what I anticipate again is, we'll probably have some good inflationary numbers. They'll run out this news of these countries are coming to negotiate. Things are looking better. It'll create better sentiment. Better sentiment equals to more buying. The market will pull back. It'll pull back. It'll pull up. And then something will happen and people will say, oh shit, yeah, right. Right. And then will fall. Okay. Absolutely. The Holland tulips. Absolutely. Right. So we'll see a pattern emerge something like this. Okay. Now, when I add on again those indicators that I like to use, right? And there's some other ones that I'll throw on there as well. I'll throw market energy on this one, but I'm also going to add on some EMAs. There's three EMAs that I like to use a lot to help me if I'm just evaluating broad markets. I don't use this to trade constantly, but I do use it to evaluate the broad market. And I'm not talking, okay, there. Let me go red here, input 50. Okay, and then I am also going to do a 20 period moving average and leave it blue and put it there. Perfect. Okay. So whenever you get a 20 and a 50 period moving average cross where the 20 period, which is represented in blue, above the 50, you're in a buying opportunity, right? So you were in a clear-cut buying opportunity until about here, right? Is that's when the market said, I don't know if I keep buying or not if I were you. And here's the next one that's a little scary, okay? Is we went and I talked about this in the S&P, all right? If I go back to the SPX, if you will, we went literally 455 days between touch of the 200 period moving average and touch of the 200 period moving average. And then we broke it. Well, here's another thing that's kind of scary. There's something that's called a death cross, meaning if this happens, all hell breaks loose mentally, subconsciously, with sentimentality. And that's when the 50 period moving average crosses below the 200 period moving average. Okay, so when the red line that's represented is representing the 50 period moving average crosses below the 200 period moving average, know that you're going to hear that term all over all the letter channels. The CNBCs, the Foxes, the NBCs, the ABCs, the PBSs, the MTVs, you name it, maybe even on F1 TV. I don't know, right? But you'll see it on all the letter channels. And the death cross, and oh my goodness, the world is in. It's not the world is ending. We needed to get back to normal values. Okay. And I think this is an appropriate time to talk a little bit of some math here. Now, I'm going to tell you, you're not going to get this concept the very first time. There's going to be a million. Some of you will, some of you won't. There's going to be a million questions that roll through your mind. And especially as soon as we end this, you're going to even have more questions. But I promise we'll reiterate this time and time again. Okay. So there's something called a multiple. All right. Now, you hear about those when they evaluate companies and they evaluate stocks and things like that, right? How many of you here has heard of multiples? Yes or no? You've heard of them, etc. Beautiful, beautiful. Okay. So let me give you insight into how they work, right? So if I own a company, right? That has a, let's call it a 10x multiple. And my company has a net profit of, let's say, $1 million. If someone wanted to buy my company, they could pay me 10 million and that would be fair value for my company, right? Because the future growth of my company based in whatever industry it's in is $10 million. Okay? That's that's what a multiple is. It's a multiplier of value. Well, historically, from like 1901 to today, the S&P has traded at a 12 to 14 multiple. I'm going to put X there, okay? 12 to 14 multiple. I want your best guess. Just your best guess here real quick, okay? What do you think the S&P was trading at prior to this big pullback? Some of you guys know. You're Some of you, hey, you're very close on. I'm honestly a lot better than I thought. 27x is what some people said 24, some people said 27. Uh, it's like which do you believe is normal, 17 or 14 kind of deal, right? So it's trading at 27 times its normal value. So how do they get a multiple on the S&P? Well, they take all the values of all companies individually, all 500 companies, and they say trading the group of these, we're going to multiply the value of those companies by 12 or 14, and that's going to be the price of the S&P 500. Well, when it gets overinflated like 27x, okay, this was what happened in Black Monday as well, in October of 1929. But when it gets overinflated by 27x, well, we know it needs to normalize, right? So how the math would work, I'm just going to do it on a calculator. Maybe next time I'll work on like an Excel doc or something like that to show everybody. So if we were to say, let's go back down here and say it was at 6,153. Okay. So if we take 6,153, which is what it was around February 19th, and we divided that by the 27 times the value it was, the actual the overall company should be trading at around $227.88, right? All 500 of them bundled up together if there was no such thing as a multiple. Well, if we then take that and we normalize it, times it by 14, the stock market, the S&P 500 should have had a value of around 3,190 minus 6,138 gives us a 2,947 point fall. That's one way that economists and banks are looking at this fall, right? So if we take 6,138 divided by 2,947, or yep, we got to do that the other way. 2,947 divided by 6,138, we're looking at a 48% market correction. That's how the math would work on the market. All right. Now, here's the thing. How many of you have money exposed to the market in your retirement accounts? Type in a yes if you do. A lot of people, right? A lot of people. There are tools out there, right? And I've shared this. I talked about this today with my team. I've talked about this in webinars. I've talked to some of you all about this as well. There are tools out there where we can invest your money in and it has what's called a 0% floor. Okay. It has what's called a 0% floor, meaning if the market fell 70%, you would lose $0.00. Additionally, some of these things are paying like a 30% bonus or a 20% bonus. Additionally, the one that I have my parents in and my in-laws in, every year they defer income, they get a guaranteed, 100% guaranteed in writing, 10% simple interest rate bonus. Okay. So, a 10% simple interest rate bonus, right? So that means that if you had $1 million every year, you get 100 grand. If you deferred, think about it. Plus, you got $200,000 for just signing up. So over 5 years, they'll basically make 700,000. Over 7 years, they may, or 8 years, they'll double their money, right? And they have 0%, a guaranteed floor of 0%. All that means is that that's how much is at risk in your account of loss. Okay. There's several different tools that I do and I share with people and stuff like that. Again, this is nothing that costs you anything or anything like that. I'm gonna send out this link right here now to everyone. This link books time on my calendar. If you guys want to learn more about this stuff, book time with me. I know some of you I invited you because we've already met before. If you want to rebook and maybe rehash this, because that like 17% fall in the S&P, you could make 100% of that back just signing up for an account. That's it, right? So you don't. I'm not here to. Again, this is not going to cost you anything, whatever, right? I just sent out the link. Use it if you want to. And I'll send it out again a little bit later on. So now that we know, like, hey, where this thing could fall down to, 3,009 something, well, let me delete, delete. Let me show you guys something interesting. Now, as my grandfather always says, cover me in powder sugar and call me a donut. But I love that saying. Um, he's definitely one of my heroes in life. There's two gaps in the market right there. Ford, um, there's some stuff we can do internationally. I can look into it for you, but feel free. Okay. So, and Andrea, I saw you just booked. Thank you so much. Again, free appointment. It's not going to cost you anything. Andrea, I got your appointment booked, and feel free, guys, to book time with me. This weekend, Friday and Saturday, I have classes, so you won't be able to book that day. And then Tuesday, I'm out all day as well. So, feel free to book. Okay. So, as my grandpa used to say, dip me in powdered sugar and call me a donut. But the gap in the market is 39.80, which is exactly right around where we said the market was going to fall to. Isn't that interesting? Right. And then if you kind of just forecast the fibs, okay? I look, fibs have their use and their place. I love fibs. I was trained with fibs. I use them. But I am not solely relying upon them, just like, Tyson isn't or anything like that. So if we said, okay, that went from the red to red, and this may do another red to red here and go from this point to this point. Well, would you look at that? Pretty much right in that zone. Right? Pretty much right in that zone of where we expect the market to fall. And this would bring us back to those 2022 levels and things like that. Right? This would bring us back to those 2022 levels. Scott, I got your appointment booked as well, and I see a few others. Olga, as well. So, Keep booking, guys. You fill up my calendar. I have a team of individuals that'll be meeting with us as well. So, I'm looking forward to it. Now that I have a team with me, it's a lot easier to stay organized and on top of stuff because they'll take over a lot of the stuff after the initial meetings and send you documents and stuff like that. So, but this is where we could end up. Okay. So that's kind of what I had for the overall arching market. Now, what I want to do, we got about 15 minutes left or so. I do have another event at 8 o'clock that I have to speak at tonight, but this is what I'm going to do. I'm going to grab me a writing stick and a piece of paper. Let me tell y'all, I got to talk low because she's in the other room. I love my wife to death, but she organizes my desk. And I'm ADD, so I have a disorganized chaos, and but it's organized in my brain. um, it's like if someone were to come into your house and organize your tools or your spice cabinet or something. Would drive you nuts. Okay, so got a pen, you got paper. What I want you to do, type in some things you guys want to look at and things like that. Okay, type in some things that you guys want to look at, and let's do a few of them together. All right, hold on 1 second. Perfect. CAD Swift, CAD Swiss, FNMAK, CAD Swiss for my Forex folks. ZT, GC. Let's see. Oh, Ford, yes, I use that all the time. Tesla. What else we got? I got XOM, Tesla. Um, Rob, good question. He said, "Hey, how do commodities hold up during major market drawdowns like this? Any ideas for commodity ETFs and defensive positions?" Defensive positions, personally, I think the best are indexed funds if you can find them, not indexed as in index to the S&P and stuff like that. There are types of funds that I have. Rob, I know we briefly discussed them one day, but they're fixed equity index funds and they allow for you to have lose nothing no matter what and reinvest at the lower rates in the market constantly. But if I were looking for defensive stuff, cash is always a position. Okay. Cash is always a position. Never forget that. CL. And Google, I know Olga. Um, the other is I really like the TLT. You got to think commodities. All right, here's the issue with commodities is that commodities are, oil would be potentially a good one if it stays stable, right? If they don't increase production or if they don't shut off production, you could see some returns there. But like copper, that could go a little haywire. Commodities could be affected greatly on both sides of the tariffs because what we export primarily in the US is corn, wheat, soy, uh, uh, hogs, and cotton. Those are like our five big major exports here in the US. Corn, CORN. Almost got me there. Okay. We might be a world exporter of that too. I don't know. The other is we import right? Especially for like take a company like Tesla, right? Tesla, random fact, okay? This is what I think is one of the I I love to like with certain family and friends and stuff like that. I always like to push certain buttons, you know what I mean? So I was talking with a friend of mine who is like the biggest anti-EV guy you'll ever meet in your entire life. EV's this, nobody should buy a Tesla, you know, et cetera, et cetera, et cetera. Well, I said to him, I said, "Hey, well, 80% of all Tesla's vehicles are made in the United States, and 52% of all the parts that go into a Tesla are made in the US, making it the most American manufactured vehicle, period. It's American owned, it's American made. So why aren't you in a Tesla?" Whereas he drives a Dodge like muscle car. And I said, your engine was the parts were manufactured in China. The engine was assembled in Mexico. It was then sent to Canada to be assembled as a vehicle and then shipped into the US through Canada. And he um uh he was just like, I love you, but I just can't stand you. He had no, like, there's no arguing it. And then, we talk about like Hyundai, right? Hyundai is a US, right? They make a lot of their vehicles for the US market here in the US, but they have a person from Spain is the CEO of a Korean car company that manufactures the majority of its North American vehicles. And I mean that like for Canada, Mexico, etc., in the United States. It's just hilarious to me of like how global of a company that is. But other commodities, I think lumber would be good. I think corn, wheat, soy. If other countries stop importing our exports, then that's a concern. That's where they'll fall. But I believe that there are certain commodities like metals that are going to do well. There's one trade in particular, and I'll go through this really quickly. SLV. I am a big, 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 big proponent of silver. Okay. So the why behind silver is throughout history. All right. Throughout history, silver has been 6 ounces of silver to 1 ounce of gold. 6 ounces of silver to 1 ounce of gold. Well, if we add on and I compare it to gold, right? You have gold is at, I don't want settings, inputs. I don't know why the comparison did like that. So we'll just go 2708 GLD is 279. What's XAU? Or GC 2996 to 227, right? And XAG USD spot. So 28 to it's literally like 100x, right? So we may get a snapback against that, right? We may get a snapback against that. So that could be interesting for silver to snap back up. So that's an area of commodities that I do like. But TLT in bonds, I think is a 20-year bond. I think that's a really good, easy, safe bet. It does concern me. I wouldn't buy in right now. I would sit in cash until it hits 89 or back to 85 because this is going to be very affected by what the Fed does. I don't I don't anticipate a raise in interest rates until Q3 or Q4 once all of this stuff kind of once we find a level ground. But could I see it running up another $6? Absolutely. Fill these gaps, be good to go. So let's run through a couple of these stocks as well. So one, Tesla. Look, I think Tesla is going to have a tremendous. They're going to come back. Let's just be real. Okay, that just is what it is, right? So Tesla, there's anything at and around 200, I think is a good buy, right? We have a gap that was filled here. We have a gap that has already been filled here. 147.26 is the last gap. And I think Tesla runs up from where I think it falls to 147, bounces, rallies, and maybe gets back up to the five, six, $700 mark. All right. I think Ford is another good one that I could see filling this gap going from $9 to $13. Let's go FNMA. FNMA. Fannie Mae. Oh Lord. I don't like this stock. I don't like it. I don't like it. I don't like it. All right. No, 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 no. Not this week. Not this week. Well, I mean, hell, it could fall $50 in a day. That's for sure. All right. Bears fall out of windows. Here's why I don't like this stock, okay? I'm gonna give you guys a stat and then I'm gonna give you a question for the follow-up. There are 900,000 homes listed on MLS and for sale by owner in the United States right now. Okay. How many vacant homes do you think there are in the US? Rob, I loved it. I absolutely loved it. You're good with me, buddy. How many vacant homes do you think there are in the US? Type it in. Well, Jerry, if that's you, wait till you hear this. Vacant homes, okay? 10% of that number, 600,000, over a million. I hope you guys are sitting down. 15.96 million homes are sitting vacant in the United States. A good chunk of those homes are owned by like the hedge funds and things like that. But there are 15.96 million vacant homes. When these begin to trickle into inventory, that is going to be crazy. And then Kathleen, great question you just brought up there. How's the foreclosure list? And this is where we'll have to leave it, guys, after this, okay? Because I do have to run because I'm speaking at a thing next in literally like probably 10 minutes. But this screenshot that I share with you that keeps disappearing because apparently it's my first day learning how to work a computer. Brand new hands and arms. I tell you, just came in on Amazon Prime. But this is Freddie Mac. This is from my Bloomberg Terminal Access that I have because I co-own a fund. But this is Freddie Mac. This is the seriously delinquency rate here in the United States right now. 6.1 million people are seriously delinquent on their mortgages. Okay. 6.1 million people are seriously delinquent on their mortgages. That means 3 months or more. And then 9.5 million people are seriously behind on rent, 2 to 3 months or more. Rob, great question. This is where we were in 2010, which was 6 million, which was kind of that peak, right, of the market. 2008, we were sitting at like 5.9 million. So this is a red alarm. If it has to do with like, and the people that are seriously delinquent are first time home buyers, so FHA loans, and then VA loans. Those are the ones that are the most. They represent like 52% of that number, if I remember reading correctly. So housing is something I'm kind of staying away from right now. You know, the best areas to be in are your energy stocks because people have to pay for their electric bill. Your your companies like Coca-Cola. Look, even though it had this pullback, if it you think about it, it's at 69 bucks. If it falls to 64, $5, take that and buy it. The dividends alone will be great. Company like Walmart, right? If it falls to 70 bucks, take it and buy it. Honestly though, if things go down and the market continues to fall, people will begin to start being dollar conscious about stuff, right? And the last one, McCormick, right? The seasoning company. This will be another one that you can take on a run up. Look, this run up from here, 56 to here, 105 was what we put a 10% of the endowment fund that I manage for the university. I literally put 10% of the fund in that, and we made covered all of our losses and made a bunch. Walmart, Coca-Cola, and McCormick were three, right? Another one like Ulta Beauty, Sephora, makeup companies will be great as well in these times because instead of buying the high end, people will swap out for lower end stuff, right? So these are things that I think you need to be paying attention to. All right. That housing market issue it's real. So, look, guys, I'm going to send out this link one more time for my calendar. If you want to book time with me, please do. Right? Please, please, please do. I have webinars during this week that we'll talk a little bit more about this. I'll use the market energy. I'll share with you guys opportunities to get access to market energy and hedge fund trender, as well as Trend Insider. Those are tools I use. I will be next Sunday. I'll be meeting with you guys. It'll be after the Masters, so expect to talk golf. If y'all don't know who the winners of the Masters in, you got to go. Okay, you can't get here. Let's see. Here you go. There you go. There's the link again for UTC, and then I'll send it to everybody. But here's what I'll say as well. We'll have next week and the week after, and continue on with these Sunday sessions. I love doing them. I'm glad they're bringing you guys value. And then I forgot to do this. Give me a second here. I'm going to try to log into this really quickly. Actually, I'll send it out. I'm going to start like a group channel where we can chat and I can send trades out, alerts out, news out, 2-minute updates every single day is what I'm going to be aiming to do. I'll send you guys that link next week as well. So appreciate all of you guys for being here. Want to wish you guys health, happiness, and success at trading. And I'll see you guys in another presentation very, very soon. Love you all. Have a good one. Bye.